It's time to get going, and we're all good, and everything seems to be working today. Amazing. Let's do the boring stuff. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and rewards and potential rewards of trading options. Damn, I was doing so good. And we're not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. That is exciting stuff. All right. How's it going, guys? We almost had a catastrophe today, didn't we? Now it's all better, kind of, sort of. I mean, wow. Okay. These are terrible charts. Let's look at better charts. Wait, first, how's Apple doing? Apple's still around 95. We're not missing anything there. Boeing. Wait, who can we get rid of for Boeing? We don't care about Netflix anymore. BA. There's Boeing. 115 is my buy spot, except I don't want to buy ahead of the Fed because God knows what they're going to do. If they disappoint the markets, we can be down 10% in no time. Look at Amazon getting back to 600. I like to short these guys again. Barry Diller said he was just on Bloomberg saying that he thinks Jeff Bezos in 5 years will be the richest man on earth. That's how much he likes Amazon. He thinks it's taking over the universe. Oil exactly hit my 3250 target. Well, not exactly, but it hit my 3250 target, and now it's back down. All good there. Gold, all the way up to 1124. Silver, 1450. Gasoline, 105. Wow. Natural gas, not doing well. Still weak, but we have, what do we decide? Another week of coal. Another week of I'm mixed up. Another week of warm weather, then it cools down. It's still too warm. Even though we had that big snow and all that, it's still generally too warm, and we're not going to get the drawers we wanted. Oh, damn, I forgot to do my phone. Oh, wow, this is an emergency. How interesting. Hang on a second. Why does my town have an emergency? Hello, town. Ooh, there's a scam. Wow. Largest scam of its kind. IRS calls. Hang on. I've never had that before. We have a town emergency alert system, and it activated, so that's why I picked up the phone, because that's kind of unusual. I was worried it might be someone of my kids at school. And apparently, there's some kind of massive fraud going on where people are calling, saying they're from the IRS, and essentially telling people they have to immediately turn over, go over their financial records, and otherwise they'll be arrested or whatever. And so they're doing this high pressure thing to try to shake people out of, like, give up their personal information. So they're warning there's a fraud going around. But apparently it must be massive. They said it was massive. They actually used the word massive fraud. That's weird. Okay, so, you guys be warned. You guys are smart, so I'm not, you probably don't have a fault for that kind of thing anyway. But I've seen a lot of scams, but this is the first time I've ever had my town actually warn me of a scam. Anyway, all right. What were we doing? We were looking at the indexes. So we took a nice run back up. We're kind of here, and I want to look on the other charts where it's going to be a little more clear. Let's see. Oh, wait. Someone has something to say about this? IRS calls from foreign people. IRS will never call for money. They will write, yeah, well, that's not good. You got one recently? Or you got a call or you got a note from the IRS? That's much worse. I'd rather have the call. Anyway, so, yeah, fake call's fine. I just don't want the mail. I would be very careful about mailing back too. You know what? It's weird. You got to check to make sure you're actually mailing back to the IRS as well. That's crazy. Wow. They should really be cracking down on these people. Instead of wasting time with other stuff, this is what they should be cracking down on. Tim Cook's comments about the worst conditions. Okay, that's a good comment. Tim Cook's comments about the worst conditions he's seen more. It's not for Apple in the long term, but for world consumerism. Yeah, well, Craig, that's why I was bearish about the irrational exuberance in the market all summer, because it was just, I was looking at that saying, we're not in that good a shape. The entire, not the entire recovery. Okay, before we get started, let's talk about that. Let's go to Yahoo Finance and let's talk about where the world is. That's a good idea. Let's start with the big stuff and we'll work our way down, right? So, here is the market. Here is 10 years of the market. Is that enough time? Oh, I didn't do the microphone muting, sorry. I hear somebody making noise.
You are now muted.
There we go. Okay. All right. So, here is the world market. All right. Let's look at that too. Let's presume that here's the internet, okay? Here's the world economy, okay? Here's the 60s. We built the suburbs. We expanded the economy greatly. Here's the 70s. We have a little recession. Thank you, Mr. Nixon. And then we come back out of it. Thank you, Carter. Then Reagan makes a little stimulus bump, but then it all falls apart. All right, and then we're into this mess. Then we have George the First comes in, and then Clinton comes to save us. Boom, 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 boom. And it isn't so much. It's partially Clinton reversing, like putting regular taxes on and giving the government money again. But it's also partially, or in large part, it's the invention of the internet. Okay, I went to college in 1981. Where's that? Here's me starting college, September 1981, and we're at 122 on the S&P. And I went with my, what did I have? I had an Apple IIc with a monochrome green screen and my Apple printer. Of course, you have to have an Apple printer with your Apple IIc. And it was like something in the neighborhood of $2,500 to $3,000 worth of stuff. Everybody on my floor wanted to use my computer, though, when they were writing papers and stuff, because it was so much faster and so much better than the alternative, which was using a typewriter. So I should have charged for it, but I just let people use it. Anyway, so I had that. That was actually, I didn't get the Macintosh not until maybe, I don't remember when it came out, but I got it, I guess it was 1984. Yeah, so I did get the Macintosh pretty much when it came out. So, but I started in 81. I had the IIc. So then here you're getting a Macintosh, and I'm out of college here, and I began selling computers. Actually, I went to work for Entree and then Intelligent Electronics. I was selling computers, and so what my job was here in 1986. So I'm going around to businesses telling people that they can replace their $2 million mainframe system with $100,000 worth of PCs. And the biggest, look, the funny thing about that job was the hardest thing I had to do was you tell someone, you try to explain to people it was not too good to be true, that we could really do this. Because you've got guys whose business is constructed around spending millions of dollars on a system, and then the money they were spending $200,000 a year to maintain the system. You know, I'm talking about medium-sized businesses, not big things. You know, like 500 employees, 1,000 employees. You know, they would have everything on these mainframes, and the programming was ridiculous in price, and everything was a fortune to do anything, and making changes was like pulling teeth, and you had to have a team of guys taking care of it all day long. It was a freaking nightmare. And so I'm coming in, I'm a kid, I'm out of college, and I'm coming in there, I'm trying to explain, I'm like, look, this whole thing is stupid. You can replace it for $100,000. I can set you up with 50 terminals, and you're going to be in amazing shape, and it's going to be better and faster and this and that. And back then, the whole thing was still expensive. That's $2,000 a terminal, what I was talking about. So that's 86. All right. So by 90. People were starting to really adapt it. I mean, this was the incredulous phase. Well, the funny thing was when I would go in to do these pitches, you're usually in a boardroom. There's not small companies, they're decent-sized companies. So you're usually in a boardroom, and who's in the boardroom? The CEO, right? He's listening to the pitch, and who's next to him, though? His head of IT. And his head of IT is a mainframe guy. But for the CEO, he turns to the head of IT and goes, is this stuff possible? And the head of IT is like, no freaking way, because that's his job. Because they know, they weren't stupid. They know that like within 6 months after transitioning the mainframe to PCs, if something occurs to the CEO, they're like, why am I paying you $100,000 to watch a $100,000 network? Doesn't make any sense, right? So there was a massive expansion, and at the same time, the internet was beginning. Not here, kind of here. So all these computers were going in place. So all these personal computers were going everywhere. And around here in the 90s, we started connecting them. All right? And don't forget, Al Gore, right around here, invented the internet. and then that was it. I mean, first the PCs came. People wanted them. They were cool. They were fun. It was an incredible thing to have in your house. They weren't alternatives. It wasn't like, now we spend money on so much different electronic junk. But back then, you had your basic TV. There wasn't a cool TV. You had the basic TV, the same one you had in the 60s and the 70s. You had the same radio. You maybe had better stereos. When I was in high school, I sold stereos, in fact. You had better stereos, but it wasn't like, you're sinking your fortune into it. And there wasn't a lot to do. Think about how we lived back then. I mean, we didn't have this constant entertainment, and we weren't spending money per month on all these thousands of different things. So a computer, even though they were expensive, even though it was like $2,000 for a computer, it was still considered affordable. You put it on your credit card, you pay $100 a month for a couple of years, and that was that. So everybody got a computer, even though they were expensive. So now everybody's got a computer, and suddenly this internet thing comes along. Everybody's like, oh, sure, I want that. And then that exploded. And if you think about how many companies now are internet companies that never existed before, right? So what's my point? My point is this is not something that retraces because it reflects an entirely new paradigm. In other words, we never had computers before. We used to live in caves, and now we live in houses. You don't project a pull back to caves, right? Because you're not going back. You're never going back. We're not going back to caves. We're not going to start doing cave paintings again. We have TVs now. Bison hunting is probably a dead thing. It's like we've moved on. We've discovered agriculture and such. We can feed ourselves. We don't have to be hunter-gatherers. Things you don't go back to, right? we're not going to go back to we have oddly enough gone back to mainframes, but it's a weird sort of thing. So we've really gone back to cloud as a mainframe, essentially. We've gone back to mainframes, but in the cloud. But we're not going back to not having personal computers. No one's ever going to willingly go back to not having a personal computer once they've had it. Even if your personal computer is your phone, you're going to not give that up. Your access to information, your access to the world, so on and so forth. Look, when I was here, it was not 80, here, okay? We had 1980, right about there, 1979. So right here, S&P 107, we had one phone and 5 kids. Okay, it was only in high school, so I started high school that year, 79, 80, 81, right. We had 3-year high school. I started high school that year. That was the year there was 2 things happened that year. We got color TVs. The kids got color TVs. We always had one, in the bedroom, but we got color TVs for our bedroom. My dad bought like 5 Gold Star TVs that were 13 inches color, and we were so thrilled. It was so exciting that we all got a color TV. He got some kind of deal on them. So we got color TVs that year, and we got, we got one more phone line. No, that was all it was. We were all so excited that we got a phone line. So the kids had their own line, and there was a house line. So instead of everybody having to share the house phone, we had our second phone line. That was a big deal back then. Could you imagine going back to that? Could you imagine trying to explain that, like, my kids are 13 and 15. I couldn't possibly even explain to them the concept of not having a personal phone number. Could you imagine if I said, you got to share this phone number? Wait for your turn. And no automatic messages, blah, blah, blah. Anyway. All right, so here we are in the 90s. The web explodes, and we have a new floor. Okay? But then it's not just the web exploding, it's that the web then creates all these efficiencies that allow all sorts of additional business to go on. And at the same time, the world economy, this is NAFTA and the giant sucking sound, actually, which is good and bad. But at the same time, we have the globalized free trade begins, and the whole global economy perks up significantly. So while we're doing this, the emerging markets are doing this. They're behind us, but they're still doubling. See, this is, here we're going from 100 to 500. Here we're going from 500 to 1,500. This is only tripling. This is going up 4 times. So really, although it looks severe because it's a logarithmic thing, but it's not logarithmic, it's straight scale. But although it looks severe, starting at 500 and going to 1,500 is not as much as starting at 100 and going to 500. So the emerging markets were doing this, and they were actually growing faster than we were, even though we did this, because percentage-wise, it was faster. So they were going through their own industrialization phase, and again, they were getting the computers. It was because it accelerated everything. We didn't have the computers when we were growing from 50, from 50 to 100 to whatever. We didn't have these computers. They had suddenly computers dropped in their lap, so they industrialized really fast. All right, so all of a sudden now the whole world's industrialized. Now it's like, hey, we could trade with these guys. They've got a phone, we've got a phone, they've got a fax machine, we've got a fax machine. We can give them an order, and I can print an order in Bangladesh as fast as I can print an order in Boston. So if a guy in Bangladesh can fill my order for 1/3 the price, let him do it. That was simple logic, right? So that's what Perot warned us about. Ross Perot, when he said there's going to be a giant sucking sound as jobs leave this country, it's exactly what he saw was going to happen, the outsourcing of American labor. All right? And look, to some extent you say good riddance to it. It's all crappy jobs mostly, but the manufacturing is decent jobs. But, there's a lot of crappy jobs that we outsource, a lot of pollution that we outsource, environmental damage we outsource. So we got benefits too. It wasn't all downhill. Anyway, so here is the natural progression of our economy from computerization and the beginning of the internet. Here, okay, is a bit overdone. For one thing, is we ramped up and we went a bit overdone, but the world trade and everything else and everybody projecting fantastic everything made people extrapolate too high. So we have a correction back to a very sustainable bottom. We go up again, but then we crash. Now, all of a sudden, we're all the way to 2008, right? Why did we crash? We crashed. This crash was because we were overly exuberant and it corrected back to where we should have been. Then we start forming a new base and moving up. A little slower than we did the time before, and we move back up. The problem is, though, there is an artificial generation that we are being driven up by housing prices and subprime loans and things like that. A lot of stuff on the books turned out to be paper profits. And when the financial sector collapsed, financials and housing really collapsed. That took everyone down with it, but for the wrong reasons. We never should have dropped like that. It was only that sector. So then we form a new sort of normal around here, around 1200. All right, that here, 1250, let's say. We form a new normal, a little bit of a base in here, but then the banks come back. Now, why do the banks come back, though? Because we gave them $8 trillion. That's why they came back. Of course, they're going to come back when you give, if they're not going to come back with $8 trillion, I don't know what's going to help. So then now we have this unnatural stimulus-driven rally that takes us all the way back up to 2000. Again, though, just like this rally, it's overdone, and it's going to correct. So here we are at 1900. The question is, how severe will it overcorrect? Keep in mind, this rally should have corrected to here, and this rally should have corrected to here, and we should have based right in the middle there. This rally should base in the middle, which is around, well, somewhere between 1850, 1750 or 1800-ish. So this rally should base somewhere in the middle. And it is. That's going to be our bottom. Now, we're calling the bottom 1850, but it could easily go 10% lower, down to about 1700, before, in any sort of like gyration this year. But my point is, it's a long point now. My point is, this is the correct price for the market. This is not the correct price. This is an irrational price based on stimulus in China, stimulus in the U.S., stimulus in Europe, blah, blah, blah. That can't just continue forever. All right? So what's real is somewhere around here is real. And frankly, knowing that, what you want to say, if you want to look at any large cap company, you want to see where it peaked out here. In 2000 and 2007, wherever they peaked out, 1,500, right? You can add 10% to that, and that's a very safe number. Because we are 10% better off now than we were in 2007 on the industrial side. The financials are just barely catching up. But we've had the cloud now is the new onus for like how we're driving web technology, making things cheaper, making things more important, efficient. And also now we have the rise of the robots. And there was a good article I posted this morning actually, in the member chat about there's plenty of them, but there was an article about industrialization and the machines and the trend as a mega trend that's just not going to stop, okay? Now, we don't need the workers at all. Before, this is what happened when we outsourced workers, and now we don't need workers at all. All right, so to think that you're going to go back to 2007, when you guys, look up if you want to know what I mean, look at a video. Not that Tesla's great, but Tesla's factory was built all robot basically. And you look at Tesla's factory and you compare that to even that Ford factory now, but you compare it to what was available in 2007, and you could never have done it in 2007. Now, everything new that's being built is being built like that, where, and that goes for washing machines, refrigerators, any large appliances. Soon they're going to start building furniture with robots. It's going to drive prices of so many things down and down and down. So that's a permanent thing. It's not going to change. We're not going back to having a bunch of workers on an assembly line. There's no point. It's a waste of time. Oh, I forgot about the Fed. I don't want to talk too much about it. What time is it? Oh, okay, half hour. All right, we don't worry about the Fed. Anyway, so we're not going back to here because we've made significant progress. Okay, so we should be around here. You got to worry about China driving us back down. Other problems in the world because China is here. China's in this bubblicious phase, and they could easily they already have done this. The question is, will they collapse further? But I don't think so. I think the government's really putting a hard line on them right about here. About 2,700 on the Shanghai is really where the government's drawing a line in the sand. So they're going to do whatever they can to stop it from falling here, which may not be enough, but we'll see. Anyway, so we should be stabilizing here, but don't think we're going back to 2,100. And if you're holding on to stocks that were at their high in August or something like that, or July, and you think we're going back there, think again. Because those were based on ridiculous earnings valuations, so on and so forth. Also, it was based on a ton of money being pumped into the economy. It's still happening to some extent. There's still, even the Fed is still doing QE. They reverse the rates, but they still go and buy bonds and roll their bonds over every month. There's another $60 billion a month that they're putting in. What's happening is the Fed has a bond, right? And the bonds have a maturity date, and they expire, and at a certain date they expire. So every time they roll over these notes, okay, they get the cash, but then they put the cash right back into the next round of bonds. They buy more bonds. So they're not stopping the QE. They're just rolling it forward constantly. But it's the same amount of QE being rolled forward to longer dates. That's not reversing QE or stopping QE. So that's still going on here, Europe, Japan, China, everyone's still doing that, at least, even if they're not doing new stuff. China's doing new stuff, and Draghi's talking about doing new stuff, and Kuroda in Japan is talking about doing new stuff. All right, so that could give us the higher end of the range back to 2,000, 2,100, but realistically, pricing-wise, don't count on things zooming back up. Okay, if we stabilize up here, still is very nice progress considering. From 2007 to here, from 1,500 to 16.5, it's 10% in 8 years. It's a couple of percent a year market growth. It's not awful. It's not fantastic, but it's not awful. But it's solid. It's something. It's a base that we can build on and then take it up to the next levels. All right, so there's that. Let's see what we're talking about in comments. Okay, so Tim Cook, that's what got me started on that. IRS calls from foreign sounding people. IRS, blah, blah, blah. Okay. Are we recording? Yes, thanks, Jim. We are recording. Accounting. Whoa, geez. Accountants, there used to be like floor after floor after floor, people with those hand-cranky calculators or whatever those things are that accountants used to use. And there'd be just rooms full of these guys just crunching numbers all day long. Gone. So, on the bright side, anybody can now do accounting very easily with a computer. On the downside, of course, 1 million people had to find something else to do. But those are soul-crushing jobs, so I don't think anybody misses it. My father, when he began programming, he was a punch card programmer. He worked for an insurance company, actually, in the actuarial department, and he used to do all his programming on punch cards, which is why he was such a great programmer, though, because, damn, you don't want to make a mistake when you're doing punch cards, because you have to pull the whole batch. You'd have like 1,000 cards that were all hand-punched with your program on it, and if there was a mistake, you had to go through the whole 1,000 cards. And of course, because it's like taking a line out of a story, you couldn't just change one card. You had to change everything, or at least from that point forward, to make it work. So you got to be really good at writing code, and you also learn to write very tight code, so you don't waste any space. Those were the good old days, right? Kids today, it drives me crazy because I learned from my father how to program. Kids today, they write the word, it's such sloppy crap. I mean, everybody writes this horrible, bloated, ridiculous code because they have no idea how to conserve. May says, are you bullish on commodities in anticipation of bottoming in mid-July? Well, first of all, we're not bottoming the S&P in mid-July. We just made a very, let's talk about that. Yesterday we had a very exciting bet because somebody asked me how to make a huge amount of money on some project he's working on. And we came up with a way to double $1 million by March. So we'll see if I'm right in a half hour. So I'm betting on the Fed doing the right thing and everything going well. But I don't remember where I said it. Well, I know what I would have said. Control F. I said Apple. I said, I forgot which China thing it was. Wow, I said China a lot yesterday. Here you go. So Jaylan, he's got this is not his portfolio. This is a college class he's in, and they have $1 million, and he wants to beat the teacher. So what I said, and this is all bullish, I said I would go with $500,000 on the SPY March 185, 190 bull call spread, and that's net 310. All right, so that's going to pay you 5 back, which is going to be a 40% profit. 66% profit if the S&P is over 1900, which is where it is now, pretty much. So S&P 1900 in March, and you make 66%. It's actually kind of a good spread, isn't it, right? Where's SPY today? Why am I having trouble thinking? Not that. Let's see that. There you go, 190, perfect. So already this thing is making money. So I mean, how could you not love options? So in other words, SPY is at 190 now. You're taking the March 185, 190 spread as of yesterday anyway. It was 310 and pays 5. That's 290. That's 190 in profit, which is 60%ish. And all SPY has to do is stay where it is. That's for flat into March, and you make 66%. What is better than that? That's why I love a flat market. Then it was 250,000 XPP. That's the ultra long China. It's the opposite of FXP. The ultra long China, March 30, 35. Now here was a bit more of a risk because XPP is a little more risky because China's way down here. And I'm saying, so yesterday we were down here at like 32. Now, well, actually it's already at 35. Look at that. In one day I got my wish. So here we're doing the XPP. It's a March 30, 35 bull call spread for 280. Now that's going to pay obviously $5. So you're getting almost 100% back on that one if China bounces, and China already did bounce. Now all I have to do is hold it, and you're going to make almost 100% there, which is what, 250,000 more. So here you're going to make 300,000 for being right on this one. Okay, so you're going to make 60% of that number. So you're going to make 300,000 here, 250 here, and then here's the riskier one with 250 of fund money. So I said, look, if you're locking in now. I sometimes get too sure of myself. So here I'm like, okay, well we have that locked in, that's for sure. So we know we have $500,000 in profits to play with. We know we have $550 in profit to play with. So we can now really go for it with 250 of fund money because we don't even need that money anymore. And now we can sell Apple, the January 110 puts for $13.40. Now, so far that's not working out because Apple's down. But the January 110 puts for $13.40. Oh, that's interesting. See, they had a lot of premium because of earnings, and they missed, of course. So let's take a look now. Here's a good lesson. How badly did those January 110 puts do? So Apple's down almost $5, and the January 110 puts are now 2050, 2065. Okay. And how much were they? Ooh, they got hit hard. Really? Exactly the opposite of what I thought was going to happen. January 110 puts, wow. So they have a lot of premium. Okay, they picked up a ton of premium today. That makes them a really good sell, by the way. I like those for a sale today. So the January 110 puts to 1340. So they're down $7 right now. And buy 10 times more of the March 95 100 bull call spread. Now, what was that? 710, 570. How much is that now? The March 95, they're down to $4. The 95 what? 100 bull call spread. And the 100s are 190. So how much are we talking about here? We're talking about 390 minus 190. So that's now $2, that spread. And that spread, oh, that is so weird. Okay, so interestingly, the spread is up 60 cents. Why? Because the implied, the premium of the March 100s got completely destroyed. So it lost a lot more value than the March 95s, which is still in a realistic spot to make money. So now, since we're buying 10 times more of these, though, we got $4 back out of the loss. It still doesn't make it all better, but interestingly, we're going to be in okay shape because the 110 puts, as we know, have too much premium, and this is still a good play, but unfortunately, this went up too much. So the profit is $6 here. We made 60 cents, so that's $6 profit, and it almost offsets the loss. I wouldn't change the trade. I wouldn't get out of it, but it does work out very well. Considering Apple went down $5, it's a very minimal loss. And why is that, though? Because we use these puts to lever 10 of these. And the 10 of these went up, even though the whole trade seems to have done worse. Now, if this one actually does work out in the end, though, it's going to be, this is good for this is good for God knows how much, but I didn't even do the math. The net of this spread was what? 1340 and 10 of those. So it's actually a credit. So you could have taken as many. You could take 1,000 of those if you want. It's a net credit, and that's because the college thing doesn't care about margin, so they're not looking at it that way. So it's a net credit, and you can do a ton of those, and it's you get 10x back on the 5. So if all goes well, this is a massively profitable, $500,000 at least in profit on something like this. Anyway, so that's what we were playing around with. So if you guys want to make $1 million by March, that's the way we were doing it. And again, this is a school project, fun money, not real money, because it is very dangerous. But there's no penalty for losing. He only gets rewarded for winning. So I say, why not go for it then? All right, so that was these. So where were we? Why was I discussing that? What goes into that topic? Oh, we were looking at the question. Commodities anticipation. So that's what it was, May. So I don't think we're bottoming in May. I think this is the bottom. I think the pre-earnings panic, all the negativity, the China panic, all that, that's where we are now. And you can't sustain this level of panic. So unless earnings are actually bad, unless China gets worse, unless Europe falls apart, there's nothing that bad going on in the U.S. economy that justifies it going down this low, going below 1850, that is, on the S&P. So you see the dollar index weakening, support of long oil. No. The dollar index doesn't work for oil, although it is manipulated for oil in the short run sometimes. But overall, you can't manipulate the dollar index. There's $4 trillion worth of Forex being traded every day, and there's a couple of $1 billion worth of oil being traded every day. So it's like a 2,000 to 1 of dollars to oil. So it's negligible in that case. I don't think the dollar index is going to go much over 100 because nobody other than Japan wants to see that. The other problem is, though, as every other currency gets weaker, the yen gets stronger, and that keeps the dollar lower because the yen is stronger. It's one of the major baskets. It's dollar, euro, yen. That's all that really matters in the baskets. The other stuff is just silly. So Dollar, euro, yen is all that really matters. And, the next one down would be the pound. After that, it's not even important. And 100 is basically a full value for the dollar, as much as it should be at the moment. And that's because the Europeans don't want to be that weak. The Swiss completely freak out if the euro gets any weaker. If it goes down to like $1, it's like way too weak for the Swiss to handle it. So they do anything they can to prop it up. And the Swiss couldn't affect the dollar if they wanted to blow their whole economy on the dollar. It wouldn't work, but they can affect the euro. And Japan, by default, the thing about Japan is, I've said this before, so I'll just say it real quickly. If you're a dollar trader, think about it. If you're an American billionaire and your financial guy tells you, look, you've got to diversify your cash holdings into different currencies. You can't just have everything sitting in dollars. So you say, okay, let's keep half in dollars and put 25% in euros and 25% in yen or whatever. See, the thing is, that's your decision because you're going to keep your money in a local currency, right? Now, somebody in Europe does the same thing. They're going to keep half their money in euros, half in dollars, or maybe in Europe because the dollar is stronger, they'll go, okay, I'll keep half my money in euros and 30% in dollars and 20% in yen, or 35% in dollars and 15% in yen, whatever. The point is, though, no matter what decision they make, if they put more than 5% of their money into yen, they're over-allocating into yen. But since you only have a choice of three things, it's natural that people make that decision. And then most of all, Asian investors, they see our currencies as really foreign and not that useful for them, as far as like they can't just go around and buy stuff with it every day. They got to exchange it again, and that costs money. So they'll keep half their money in their local currency and a good portion in yen. So that's why the yen has a constant buy on it, even though it's a very, very small by comparison currency. Because it's so small and because it's always in demand, it keeps it much stronger than it should be, much lower in net price. It keeps it much stronger than it should be because it's constantly being demanded. No matter how low they drive their rates, no matter how much money they print, there's always a constant hunger for more yen because there's just not enough of them going around. Not enough to feed a growing Asian economy and not enough to feed the diversification of our portfolios where we'll put a little bit of money into yen also, even though it's a ridiculous currency with a 300% debt to GDP and all that. It's insane to put any money into yen, but people do it because what's your choice? People do not look at it rationally. They just sort of say, okay, I'm going to allocate. Just like when you do a 401k, and the guy comes to you and he's like, oh, here's the 6 funds you can invest in. And he goes, you're like, oh, I wouldn't pick any of those if I was picking from scratch. But you end up going, okay, that one, and that one. And then they're diversifying the money into yen and whatever for you. So that's why the yen stays very relatively strong no matter what they try to do with it. That's why the dollar won't go out of control strong either. And the other factor there is, of course, the euro is already so beaten down. Okay. XE. Oh, how do I remember all these symbols? So amazing. This is what people forget. The euro's already down. It's down like 30%, basically. It's down 30% from 2014 in just over a year and a half. 30%. That's a lot of percent. How low is it really going to go? Unless the European Union actually does break up, and nobody wants that. Nobody can afford that. Everybody's got their money in euros. Everybody who's going to vote on it has their money in euros. It's not going to be better if they vote themselves out of the EU. It's not going to help. Okay, first of all, you have these passports and you get to go anywhere you want. You don't get customs. You don't get duty. And people in Europe travel. It's like us going to different states. They travel to different countries like we go to states. So there's no customs. There's no duties. There's no things. They can work where they want. They can go where they want. They don't have to have papers. They don't have to wait in line at airports, so on and so forth. Imagine giving all that up. Why? What benefit is it going to be to you to give that up? You might be disgusted by the EU. You might think they're a bunch of schlubs, and you might not like the way they do business, and you might think things are better. You might have a Trumpy sort of person in England, and they just elected him too, who's going, oh, things were better in the old days, and let's make England great again, and let's get rid of these EU idiots, and blah, blah, blah. But when push comes to shove, England does business with Europe. And they travel to Europe all the time, and they do, and they don't want to suddenly put up walls and make it a thing. That's not, it's not likely to pass, not in the broad population. There's going to be a segment that's going to be super supportive. Just like, what you're going to see with Trump is there's enough people in the Republican Party to make him, to get him the nomination. So when you go to the broad election, either Bernie or Hillary will kick his ass because there aren't enough crazy people in America to back this guy. There's enough crazy people in the Republican Party to back him, but not enough crazy people in America. So it might sound great, and the guy who got elected in Europe to be the minority party, he's great for the minority party, but they're not going to become the majority party running it like that. Not saying let's get out of the EU. But it makes the good news stories and it keeps people talking, so they just keep churning it, even though it's completely unrealistic. All right, anyway. So that's that, and there you go. And that again is why the dollar isn't going to be that strong, because the euro's not, the euro is not going to collapse, the yen's not going to collapse, and the yuan is a not important currency. But even if it does collapse, all it's going to do is make the yen stronger. So in other words, the yuan is a 1% of the dollar index, or not even 1% of the dollar index. I'm not sure it's officially in the dollar index. But the yuan is nothing. It's a nothing currency with a very low float and so on and so forth. So the yuan could completely collapse tomorrow and nobody cares. But you know what will happen? A ton of money will flow into Japan. And that will make the yen stronger, and that will matter to the dollar. So it's going to be, people are going to be very confused if China's currency does collapse, which probably won't happen. But if China's currency does collapse, and then the dollar will go down, and people will be like, how the hell could this be happening? It's going to be because the yen will get stronger. All right, so, where are we? Buggy whips. I love that buggy whip speech. Danny DeVito. All right, where are we? So rolling QE. Yeah, QE doesn't stop. QE. Now, here's the thing. In order to stop QE, the Fed would have to then redeem their bonds, collect cash, and not recycle it, and therefore put more cash in their balance sheet and reduce their debt, which is like $5 billion at this point. So they would have to start selling their bonds, which are the asset that's backing their $5 billion in debt, and sell the bonds and then turn into cash. And that's how they end QE. But to do that, there's still a need for more notes to be sold. So if the Fed stops doing it, somebody else has to start buying it. Otherwise, the rate on our notes is going to go skyrocketing, and that would be a disaster, right? So the Fed can't stop. They're trapped. They trap themselves. Boy, man, you asked a lot of questions. All right. With QE, how will big banks and GS and JPM do? Well, what's with QE? I mean, we are in QE. A withdrawal of QE, they won't do as well because interest rates are going to go up. But on the other hand, they make money on the spread of interest rates. They don't really care what the rates are. Lower interest rates do hurt the banks because it's harder for them to get a big yield from the notes. It's hard for them to compete when everybody's offering ultra low rates. So it's a little bit better for them, but not great. It's better, but there's a transitional period, just like with the REITs. With the REITs, there's a period of transition. But in reality, when the rates go up, the REITs are the guys who get the better loans. They get the lower interest loans, and they can compete better and make more money on the same development than a small developer can. The way things are going now, any idiot can borrow at 3.5%. So the math works for everybody, and the REITs have to pay a lot of money to buy a new development, to buy a new building, so on and so forth, because they're competing with local yahoos like any guy with a good bank book can buy a $20 million building these days. Because it's not that hard. If you are a fairly well-off person, you have a good credit rating, you can go to the bank and you can arrange a business loan and pick up a building. Because the banks, they're sitting on trillions of dollars. They don't know what to do with their money. They love putting money into assets. That means the REITs have to compete with a lot more Donald Trumpy type people who are developing next to them. Whereas when rates start going up, there's very few people who can compete on that level, and that's better for them. Still, I love REITs down here. We had a whole talk on that the other day. But how are we doing on time? You almost said 10 minutes? Is that right? Yeah, 10 minutes. All right. Meanwhile, the Fed's not doing anything. The rates aren't going anywhere, so it's not really much of an issue. You know, if they raise rates 1% this year, that would be huge, and I doubt it. More likely half a point this year if they get around to it at all. What is it about the butterfly portfolio that makes it self-hedging? Well, we get both sides. We basically, generally, not all the positions, but generally in the butterfly portfolio, which is where, what's this? Oh my God, really? Hang on, let me refresh this. 10%. Wow! This portfolio, which I said we should ignore last week, right? We talked about it last week in the webinar. This is the 5% portfolio, what's called now the options opportunity portfolio. It was down 42% last week, and now it's down 10%. So it came back $32,000 in a week. So that's pretty good. I had no idea. I didn't know that it came back so fast. Same positions, no changes, other than I think we added something. But butterfly portfolio, oh, it's having a nice time. Look at that, 91%. That came back huge, too. That was down to like 70-something%, and that's up $20,000. And again, because the reason with the butterflies, we have a certain amount of push and pull. Like we're generally selling within a range of maybe 5% up and down on the stock, or at most 10% up and down. So when the market goes more than 5%, it pushes our options out of the range, and then we end up losing a little bit of money that month. So in this case, since everything went down really sharply, all of our positions lost a little bit of money, and we didn't look good. But we did the right thing. We ignored it. All right. The guys at PSW have been doing this thing since 2013. They know. Ignore it. We don't even bother adjusting, while it's happening, because it's going to come back. You'll find out what it is when we get to expiration day. Then we'll make an adjustment. But there's nothing to worry about with these positions. And why? It's because what do we do with Disney? No, bad example. Oh my God, all these positions got so bullish. Oh dear. Okay. Valero. Wow, we turned so bullish on these positions. Because as the market sold off, we made changes that made everything more bullish because everything, it got too cheap. That's why we made this sharp recovery, because we got bullish. So anyway, Valero is a classic butterfly. We buy the long call, we buy the short call. Now, if you're buying the long call and buying the short call, how are you going to lose money? No, not the short call. Damn it. I'm sorry, that's wrong. Seriously? Do we have no regular butterfly positions? I'm sorry, that turned bullish too. I am embarrassed. Holy crap, this butterfly portfolio is nothing like a butterfly portfolio anymore. Long call, short call, long call, short call, long call, short put. Whoa. Long call, long put. Aha! OIH. Thank God, there's one. Oh, I'm so embarrassed. Holy crap. That is just too funny. What happened to Texan? I got to figure out what's going on with that one. That's got a long put. All right. Anyway, so TXN and I'm sorry, this is too funny actually. So TXN and OIH are only real butterflies. The long call and the long put, that's what we're supposed to have. We have a $30 call and a 25 put. That means either way it goes, one of these positions is making money. And so what do we have here? He lost $25.70. He gained $18.50, right? But we sold, and we only have the short puts here. We sold the put for $4.20. And we sold a lot of them. We sold double the amount because we got bullish here too. Every one of these positions we flipped bullish. We sold 20 puts at 420. So now if OIH is over 25, we're going to make $8,400, which way more than makes up for the little tiny amount, $700 we lost over a year. That's why it's self-hedging, though. In other words, we're selling a lot of premium in both directions. Usually. But what happened is the market was way down not last week, 2 weeks ago when the options expired, and I flipped all these positions bullish. And I don't intentionally do it. I don't go into it saying I'm going to flip every position bullish. I look at every position one by one and think about where I think it's going to be next month. And based on that, I create a target. And it just turned out that all of these positions, for the most part, we decided to be a little bit more aggressive. And that's why we have these weird things. So presumably we're going to get back to more conservative positions at the end of the month. But there's a long put on Blair, so you do still have a long put laying around there. We're going to get to more conservative positions at the end of the month. But the idea when you start, if you take a long put and a long call in 2018, usually, we try to go as far back as we can, 2018. So we don't care if it goes up and down. They're just placeholders. But what they do is they keep you from going bankrupt. Because then, in between the long call and the long put, you're going to sell short calls and short puts for the next 2 years. And you're going to collect a little bit of money, a little bit of money, a little bit of money. Meanwhile, as long as you don't lose all your money here, all these guys are doing, the long put and the long call, OIH, the long put and the long call cost $385 plus, let's say $8. So these two things cost $8, and they're protecting us from what happened now. Here's OIH went to 22, went below the 25 put. If it went to 0, we'd be pretty screwed, right? But it won't, it won't because it's an ETF. But if it went to 0, we'd be down $20 if we sold a short put. So this prevents us from taking a huge loss because this will make money. All right? And meanwhile, I'm sorry, the 45. No, that's not OIH. Long put, the $25 put. The $25 put will prevent us from losing too much money. We sold the July $25 puts. We double sold them, but so it's a little more risky. But the point being, though, that as this goes under 25, this serves as a buffer for us. And we can't lose too much money. We can still lose money, but not too much, hopefully. And that's the gist of how a butterfly is supposed to be. It's a little messy now because if you're joining it late, this is, that's what happens to these butterflies over time. They tend to fall apart because we keep picking a thread out and picking a thread out, depending on which way things are going and what's doing well. Sometimes something goes too high and I'll sell the calls, the long calls, because I'm like, well, that's as high as we think it'll go, so let's flip short on the stock. So we do make adjustments. But generally self-hedging, and we always try to have bets in both directions. What are your thoughts on Netflix? I still think Netflix is overpriced, but not so overpriced, and I think it'll survive. And we have a short 91 puts. I think there's short January 91 puts in the options opportunity portfolio. And again, it's left over because we had long puts that we cashed in, and now we're left with the short 95 puts that were part of the spread, 91 puts that were part of the spread. And we're just going to let it ride because, frankly, even if it goes badly, we can roll those to the 2018 85 puts or something like that. And I really don't think Netflix is going to go below 90. If it does, we'll deal with it. But it's only like 5 anyway. It's not a big deal. But I wouldn't play it. I mean, I certainly wouldn't play them long. I think they're still overpriced, but they'll grow into it over time also. So it turns out patient one bit. But why would I buy something that's overpriced and grows into over time? Here comes May again. Wow, May, you are really big on the questions today. What do you expect the Friday GDP? Oh, wait. You don't distract me. What about the Fed? Sorry. All right, we'll leave Netflix as the last question. Now let's find out what the Fed's doing. Oh, we got 1 minute. Hang on, TV time. Let's see. And again, you know what? It doesn't matter. I said that this morning. It doesn't matter what the Fed says. What matters is what John Hilsenrath of the Wall Street Journal says. Um, 15 seconds to the Fed. No, wait. Oh, I assume when I refresh it, it's going to pop up the statement. Okay. Unchanged. It no longer feels the risk is balanced. Okay, they said risk twice. Here we go. Hang on, get the summary. Future rate hikes gradual. Oh, for God's sake, he's just reading the thing. Okay, I'll read it. Okay, so what do we got here? Meanwhile, there's no real big reaction. It's a little bit bullish. Okay, labor market conditions improve further. We know that because we had some really good jobs numbers. Household spending and fixed investment increasing moderately. Household sector improved further. Net exports soft. We know that. Inventory slow. We know that. A range of recent labor indicators, including job gains, point to additional decline. God, that's a terrible sentence. A decline in underutilization of labor resources. In other words, the improving labor. Inflation has continued to run below the long-run objective, 2%. They can't put a percent sign. 2% long-run objective, partly reflecting declines in energy prices and non-energy imports. Correct. Market-based measures of inflation compensation decline further. Survey inflation compensation, so Social Security and COL cost of living increases. Survey-based measures of longer-term inflation expectations, a little changed on balance in recent months. Consistent with its mandate, the committee seeks to foster maximum employment and price stability. The committee currently expects that gradual employment stance its monetary policy, economic activity will expand at a moderate pace. So they're still thinking the economy is good and continue to strengthen. That's very good. That's a bullish thing. Inflation, it's a bullish thing they're saying. It doesn't mean it's really bullish. It's just that they're saying something bullish. Inflation is expected to remain low. Further declines in energy prices. See now here, if energy prices are picking up, then that changes their inflation expectations tremendously. But 2% over the medium term, transitory effects of declines in energy. So in other words, this will all wash out, and labor market will strengthen. And it's very odd they don't mention the fact that there's all these minimum wage laws are changing, which is going to definitely change the labor prices. So we are going to get some nice pop in inflation around the middle of the year. The committee is closely monitoring global economic and financial developments and is assessing their implications for the labor market and the balance of risk to the outlook. Okay. Given the outlook, the committee decided to maintain the fund rate. We know that. Stance of monetary is accommodative, thereby supporting further improvement and a return to 2% inflation. So they are pushing for 2% inflation, which we're not at. In determining the timing and size of the future attempts to adjust the target range, the committee will economic conditions. Its objective is to maximum employment, 2% inflation. Boy, they're really talking about this target. How's 2%, 2%, 2%, 2%? They are telling you exactly what they need to do. And what they're saying is anytime you get a report that says inflation lower than 2%, they're not going to raise rates. That's what they're telling you. And that's basically telling you they're putting off a rate rise quite a while. Labor conditions, inflation pressures, inflation expectations, financial improvements. Committee will carefully monitor actual inspected targets. Committee expects the economic conditions. So the Fed is basically now giving us a number. Not that they haven't mentioned it before, but this is like over and over again, 2%, 2%, 2%. If we don't have 2% inflation, they're easy. Or they're keeping things easy. Committee expects conditions will evolve that will warrant. So even if they get better, it will warrant only a gradual increase. And it will remain below levels that are expected to prevail for the long run. However, the path of rate will depend on the incoming data. They work with that. The committee is maintaining this policy, principal payments. Okay, so in other words, they're still going to roll over debt. It's maintaining its policy of reinvesting the payments from its holdings. So in other words, everything they have outstanding, they're going to roll it over. Treasuries at auction and over-maturing treasuries. It anticipates doing so until normalization. The level of Fed funds rate is well underway. So they're going to keep QE running for a very long time. That's what they're telling you. And voting for it were everybody. This was a unanimous decision of the Fed. All right, so that's that. Now, we go to the Wall Street Journal, and we see what Hilsenrath says about it. Said the market, dollars rise. Come on. Live coverage, is that it? No, that's not it. I don't know who this is. Wait a minute. I don't want to play a video. I'm not sure if it was. All right. Sorry, we don't have him yet. This is things to watch. We'll have it shortly, I imagine. Anyway, so same as it ever was. Let's see how the markets are doing. Oh boy, wow, that was a real gyration here. We're right on 1900, right? 1607, we went long before. That was a nice run we caught here from 1616 150. Everybody's just, it's really maintaining, but there's a lot of gyration here, but these are the levels that we're going to be at. This is exactly what we expected to happen. So all good, not better for oil, as you can see here, nothing for the dollar, no effect. No effect on natural gas, but it is kind of getting to be a buy down there. Nothing on the treasuries, nothing on gasoline, of course. Gold staying, silver popped a little bit, silver liked it. Apple still down at 95, and Boeing still at 117. Really? No movement? It's just broken? I guess not. How is that possible? Is the right sign? Yeah, all right, well, so a big nothing. But that's good. A big nothing and we're not losing ground is good. So what do you expect with the GDP report here, Mark? It's nothing. The GDP report is the third revision to the GDP, so it means almost nothing. It's also, there's interesting, that Williams from the Fed is speaking right after the GDP that day, like in the afternoon. So they're worried about something. So I think it'll probably be revised down slightly, and they have Williams in case we get a bad reaction to it. But now, with what the Fed just said, we're going to be kind of back to that bad news is good news thing. If the economy doesn't look strong, then the Fed's going to keep on keeping on, and we're not going to have to worry about rates rising. And that's good because they're giving away money every day. Use SDS on your spread. You have long March 23 calls. Not the SQQ. How can you adjust it to protect myself in case SPX zooms up? Well, if you have that before the Fed, then you don't have to worry about it because you don't have to do anything. Well, usually we have a spread. So SDS, where is SDS? All this stuff depends. You have to understand because it depends on what you're protecting and what your goal is. And you're telling me you have March. I would never have had March without having the spread. So SDS is a 2250-ish. And you've got long what? You've got long 23. So, you know, naked calls are not protection. Naked calls are a bet. There's a very big difference between protection and a bet. And when you buy 23 calls and you pay God knows what, but they're $1.30, you're betting $1.30 that SDS goes up. That's not a hedge, that's a bet. If you want to hedge, then you want to limit your exposure. So you buy the March 21s for $2.30, $2.35, and you sell the 24s for $1, and now you're spending $1.35 or $1.30 or whatever. So you're spending $1.30 on a $3 spread. You got 100% upside, and you're $1 in the money. So the only way you can lose money, you're $1.80 in the money. So the only way you can lose money is if the S&P goes up. That's the only possible way that spread could lose money. You understand the difference? You lose money if the S&P doesn't go down enough, and if it goes up. If it goes up, you lose money. If it doesn't go down enough, you lose money. With my spread, I'm going to make 100%. How much you really need to make? I'm going to make 100% if the SDS only goes up to 24, which is up $1.20 from here. Very tiny move. I'm going to make 100%, but I'm going to get my money back if it's flat, and the only way I lose money is if the S&P goes up and the SDS goes down. Anything flat or down, I make money. The only way I lose money, on my hedge, my 100% hedge, is if the S&P goes higher. So if I have a portfolio that's going to make the problem is it's not just a single thing hedging, because all of our portfolios at Phil Stock World are based on the concept that in a flat market we make money because we sell premium. We're being the house. So in a flat market we make money. In an up market we make money. In a flat market we make money. We only lose money in a down market. There's only one way we lose. So a hedge covers the only way we could lose. Because in a flat market, we still get money because we sell premium. And you know who we sell premium to? Suckers like you who buy naked calls. That's who we make money from. Do not buy naked calls unless you know for a fact you're betting on a short-term event. Naked calls are terrible investments. You buy 23 calls, they're $1.35, and they're 25 cents out of the money. So unless the SDS goes up 10%, you don't even get your money back. To get profit, that's not a hedge. How is that a hedge? Your stocks have to lose so much money that the S&P went down at least 10%. For you to just get, or 5%. Your stocks have to lose at least 5% before you even start making money on your calls. Where's the logic to that? My spread, I'm already 50 cents in the money. I make up to 100% back on my bet, or I'm over 100% on my bet if it goes well. If it goes down. And the only way I lose is if everything else in my portfolio, all my bullish positions go up. That's a hedge. All right? So it's not a one thing, but just because you say the word hedge and you buy a position that we talk about, that doesn't cover it, okay? It's all about how you manage your whole portfolio and how you run everything and how you balance everything internally. And again, our portfolios themselves are balanced. So when we add a hedge, it's only to take, it's like when you're balanced on a surfboard and you make a minor adjustment. The hedge is a minor adjustment to cover $10,000 or $20,000 we think we're going to lose. It's not like that's how we hedge our whole portfolio. Our whole portfolio is hedged by being balanced in the first place. These are adjustments. You can't just slap SDS on and say that's a hedge for your portfolio. That means you weren't balanced and don't have a good plan. So you have to, it's in context, okay? I don't want to give an answer other than the fact that you really need to work on all this stuff. That's my answer, is you got a lot of stuff you have to work on if you're asking a question like that. Alice there says, Europe except UK, they're going to vote soon. Yeah, they're not going to vote. They're not going to leave. So it's all nonsense. It's all being stirred up by Murdoch with his friends. It's all garbage. Down negative, do you expect a pop from the Fed if they maintain? Oh, well, it was probably old. Now he's turning down. Look at that. Wow. Somebody decided they didn't like it. All right, well, now we're going to see what holds, because that was nasty. Holy crap. I don't know. That was weird. All of a sudden, everybody decided it was terrible. Okay, 1 minute to the Fed. Would you trade TF now at 1,000? Is TF at 1,000? It's at 105, right? I wouldn't. I won't jump in it like a knife. The idea is to play the cross when it goes over 1,000. Not see when we make these calls, when we say TF 1,000, the idea is to play it when it crosses over 1,000 on the way. Oh, what the hell is this? Oh, I see. So the idea is to pick it up as it goes over 1,000, not all this is still over. Here it is. When it dumps along and goes over 1,000, even if you miss it at first, I mean, the idea is to say, okay, we just went over 1,000. This is where you want to get bullish. Not, if you're catching it here, that's more dangerous. But certainly, if it's been over 1,000 and now it's at 1,000, that's not where we want to play it, really. If you do take it, you can take it, but you've got to get right the hell out if we don't hold 1,000. But the best way to play the futures is to wait for a cross that goes over. Now here, see 4150? That's a good line on the NASDAQ. You can see right here, the pink even, 1880, good line on the S&P. 15.9, well, I like 16. I would prefer to wait for 16 on the Dow. The Dow's finicky. But if all these purple lines hold, see how we're just coming back to these midpoints, except for the NASDAQ, which is being dragged down by Apple. So we're going to give the NASDAQ a pass. Oh, but we went long this morning, 1005 on TF. And that's still a line if it holds. And like I said, I don't care that the market went down. I read the Fed statement. I'm fine with it. So whether it doesn't matter to me that other traders don't understand what I just read, I know what I read. So I'm still bullish. It's not going to change anything. Oh, you broke the spread. You took profit. That's much better, May. Okay, so you do have you are doing the right thing. So in other words, I would roll down. I would sell those other calls, and I would roll down to the better spread. That's all, and then end up with the 21-24 spread. Because that's a useful spread, because then you can't lose, right? You can only lose the amount of spread. So let's say you have a $100,000 portfolio, and you put $5,000 into the spread, right? 5% of your portfolio. So between now and March, first of all, at flat, you're going to make a little bit of money. You'll make 20%. You make $1,000 if it's flat. If the S&P goes higher, then you're going to lose a little bit of money. And the higher it goes, the more you're going to lose. So the S&P goes up 3%, let's say, you'll lose $2,000. That's your insurance policy. You're taking the $2,000. You're basically taking that money that you're going to lose against the gain in your portfolio, and you're also going to obviously negate the gains. But what you're doing is you're making yourself neutral. That's what a spread does. The hedge does. It makes you neutral into a period of uncertainty. It's not magical. Now, of course, if the S&P flies up 10% and your portfolio makes $10,000 and you lose $5,000 on your hedge, assuming you don't pull the plug, of course, then you make $5,000. It doesn't stop you from making money on a really big rally, but on a mediocre little move up, that's what's going to kill you. And then you're going to lose on the hedge. But on the other hand, once you feel satisfied that we're not going down, you can pull the hedge, or you can roll the call you own out to July and make a July spread to protect you for the next 6 months. So it's always fluid. And like I said, think of it like you're surfing, okay? You're making a minor adjustment here, a minor adjustment there. You look ahead and see what the market is throwing at you, and you try to keep yourself balanced. That's what they're for. All right? I mean, and if you're in chat, if you're a member in the chat room, let's talk about it on a regular basis. Like, it's something you got to learn over time. It's not a quick solution. But you understand what I'm saying about the spread, though. It's much better to go with the spread. On the S&P, what's your view of the trading range in the next 6 months? 1850 is our center point, which is the same must-hold line we've always had. I think 10% up or down for that. I think you'd be lucky to make 2,000 at the end of the year. I think 2,100 is not a realistic number. All right. So let's see what Mr. Hilsman had to say, if he says anything. Here we go. What's news? Fed funds target rate. Maybe that's the article. There you are. Oh, sign in. Really? No, I don't know my sign in. It's not mine, it's Tina's. Damn it. Oh, no, wait. This one's mine. That's Tina's. It's the New York Times. Your nobody say my username, please. Yay, guess it on my first try. All right. I use my unimportant password. All right. Okay. Federal Reserve signal renewed worry about the financial market. Wow, you see that spin? Renewed worry about the turbulence and slow economic growth didn't rule out raising rates in March. Wow. No wonder we crashed. Wow. Look at the power of this man. There is no way, reading that statement, that I took that out of it. I mean, yes, they were worried about financial market turbulence. Yes, they didn't like the slow growth. But didn't rule out raising rates in March? Of course they did. Logically they did. They didn't write it down. But they said 2% growth, unless we have this phenomenal economic turnaround in the next 60 days, it's out. That's an idiotic statement. Wow, so no wonder we crashed. That makes me more bullish, by the way. That makes me very much interested in going long. Because that is an idiotic take on this. They're closely monitoring developments. The Fed officials said they believe the economy is on track, produce jobs, lift inflation, despite worries that this is a really weird interpretation of it. However, officials were agnostic on whether the outlook has shifted in light of developments, and since the last meeting, a sign of some lack of conviction. The Fed is closely monitoring economic and financial developments and assessing their implications. The balanced risk to outlook. Holy crap, that is the weird. I've never seen something like this. Now, what are the comments here? Why does the Fed allow markets rates to be market priced? Interest rates are good. Oh, please, he has no clue. Any way to get this person to shut up? This is why I hate public chat. It's like it's animosity immediately. Who wants to bet more on the Federal Reserve and shorting the market? Oh, please. All right, whatever. So, idiotic comment from the Wall Street Journal. This is an idiotic comment. No comment more idiotic than this. There's no way you can get that take out of that. No frickin' way. Holy cow. Oh. Oh, wow. That is too... Oh. I told Reuters Reuters wanted me to do a live commentary on the Fed, but I was doing this, because usually I do Wednesday. I was late into this guy, man. What a jerk. All right, anyway, so here is an opportunity. See, when we know something other people don't, it's an opportunity, right? So, oh, damn it. I wasn't fast enough. Everything's bouncing. See? This is what I mean, though. That made me more bullish. By reading that statement, by seeing what Hilsenrath actually said, and understanding that he caused that spark down with what he said, that makes me bullish and want to go long on this stuff. And you see it already popped up. Damn, right off those pink lines. Hey, pink, oh ho. Damn it. That would have been such a good example of how to make money. All right, anyway, it's still good, though. Everything's fine. Oh, wow, that is so, I cannot believe that's what he said. And you see the power of this guy, though. He knocked the Dow down from 16,120 to 15,920. He knocked the Dow down 100 points with that paragraph. And he's completely wrong. Unfreaking believable. I've never seen anything like that. But those are the opportunities that we go for in the market. That's exactly the kind of stuff that we love because we can make money on it. Because when you see information that moves the markets that's wrong, you can make a fortune, okay? Going long was the easiest bet in the world just then. In fact, here's the Dow at 1620, so let's take a look at that one. Well, I want to get something out of this, so I'm going to be pissed. Active trader, YM, good, okay. So let's buy. Hello? Oh, it filled, okay. It's coming down. We'll buy another one soon. Whoa, look at that. Okay, I'll buy another one there. No problem. Oh, no I won't. Canceling that, of course. Oh, wow. Should have been a little more greedy. Get my 16,000. Okay, look. Ow. All right, take one there. Oh, didn't get it. I hesitated. Oh, can you believe that? Come on, cancel. All right, there you go. All right, so I have the one at 16.17. Next time it comes down to 16, I definitely want to get in, or 16.05, let's say I'll buy. Okay, I'm going to put my buy in. Oh, there it goes. Come on. Whoa. Interesting. I'll follow it down. So all I have to do is drag this thing down to follow it. So if I'm losing money, there it goes. I finally got to fill. All right. So now my average is 16.07. If I want to get another one, it's going to be now in my mindset. If I want to average 16, what I want to do is I want to get another one that's 7 points below 16, so they'll average 16, right? So what's 7 points below 16 is something 3, 93. Whoop. But what happened instead is it popped over. Whoa. So I'm going to sell now, and watch what happens. So now I sold. Oh my God, isn't that weird? I'm up 100 all of a sudden. All right. So now my average, because I sold one, my average is now 15,997. So now I'm where I want it to be. I'm at 16, even though I came in with a bad entry. Because I now bought another one lower, and it popped back in. As I sell that one, my average is now much lower. And it's where I want it to be. So now I'm happy. Now I'd like to get another one at 16 or so, if I can. But you see how now I flipped a $135 loss into a profit in seconds. That's how you scale in, but you have to remember to scale out. Scaling in is no good if you don't scale back out. And then I'm watching the other guys. He's doing okay, 108. The NASDAQ, 4171. So making sure everybody's happy and going high at 18. He's having trouble at 1895, and we'll see what happens there. Whoop, down we go. Let's see if we can get another fill. You know, I'm almost getting to the point where I want to take $100 and be done. All right. You know what? Oh, didn't fill. I'm going to get out with $100. So I was willing to get out with $100, and now it's already back to 16. So now I've got to say, so I'm going to follow through my plan and double down, and yes, I am. I wanted more than one. Oh, come on, no fill? Very frustrating. It's bouncing around like a pinball. So by the way, if the Dow is annoying you, you can always switch to the S&P, and we can play the S&P, but I don't like the line on the S&P. I like the line on the Dow. I can go to sleep at 16 and not worry about it. Oh, back up here again. I'm either going to sell for 100 and get out, or I'm going to get my other piece. Whichever comes first. How's that for ambivalent? All right, so 06, 03 is basically my buy point. Look at it. It's like avoiding me. I could be the only person in America actually trading this. You never know. So I know what my buy point is because 03, what's going to happen? 997.03, I end up with 2 at 16,000 even. But on the other hand, right about 16, 17, I'm happy to sell and take my money off the table. We're not getting confirmation from the S&P, but here's going to make another little move up. What did I say? I'll take 100. I did say that, so I better do it. There it goes. $110. There you go. And that's how you make $110. Any questions? All right. So I don't want to make nothing. I'm going to get annoyed by making nothing. And he won't go to jail. No, Hills and Math. Look, it's his interpretation of what they said, but it's a terribly wrong interpretation. He certainly knows better, so he's playing a game with somebody. Somebody, and frankly, the Wall Street Journal, he could be home in bed today, and they could be printing whatever the hell they want, and some other person could be writing under his name. Who knows? I'm frankly, I shouldn't be letting him off the hook, because that's a terrible thing. There's no excuse for what that is. But anyway, so what it did is it faked out a lot of people and took a lot of people out of perfectly good positions. Oh, look, came back down. But let's remember, though, here's the thing. Oh, let me need a better picture. Here's the thing, though. Look, 1892. No, so now I'm not going to get back in, even though it's at my point. The other guys are looking weak, so you don't get back in when things are weak. Okay? But they are making triangle squeezy thingies. See this triangle? See down triangle, up triangle? They are squeezing to an inflection. They're going to blow up or down shortly. And 16,000 seems to be where it's going to stick. Now, my bias is to the long side. I think we're going to go higher, but I'd like to see a confirmation from one of our indexes that that's going to happen, but I think we're going to blow suddenly higher. That's my theory. See how these things are consolidating, like squeeze? That's called a triangle squeezy thingy. That's our official term for this. Highly technical. But you see how this down wedge here is meeting the up wedge here, and the range is getting sort of ping pong between the two? All right? Those things resolve at some point like a bullet coming out of a gun. It's going to get fired up or fired down after it squeezes itself out. So all the indexes are consolidating because there's a huge amount of indecision. Now, effectively, what's going on? Oh, there it goes up. Effectively, what's going on? All these hedge funds are sitting there looking at the Hills and Rath statement. They're looking at the Fed minutes. They're trying to figure out what the hell's happening. They're listening to all these morons on TV that I'm watching right now with the sound off. And they're all just talking out their asses. Nobody knows what's going on. It's like the five blind guys with the elephant trying to figure out what it is. They all have their own interpretation of everything. But I have to go with my own gut. My own gut says that was a bullish statement. That was exactly what the market needed to get back on track. But my valuation matrix on the Dow says that we're not going to have a big rally. It's just going to be bullish as in not bearish. We're going to go up a bit. We'll drift back higher from here. That's fine, though. That's what we're betting on. That's why our portfolios had such spectacular performance in the last week. Because that's the bet we made. We didn't bet the market was going to go flying back up. That would be a stupid bet. We bet the market would flatten. And those are extremely rewarding bets when you play them correctly. See, that's damn, I should have gotten in that next one. See, exactly what I said, though. The little triangle thing, and then pop, and up we go. All right, so now we're back to just sort of watching, waiting, and see where we finish. That's all. And what's more important now, though, is the 1900 needs to be held. That's a weak bounce. And because we don't think we're coming back strong, a weak bounce holding this week will be fine. And what's today? Today's Wednesday. A weak bounce holding for the week will be fine. And a strong bounce, but then next week we need to come back to the strong bounce line of 1950. If we can hold 1900 this week and make 1950 next week, that means we're making a slow recovery, not a V-shaped recovery. It's a slow recovery to the new normal, and the new normal is around 16,000. Okay, obviously, we want to test the upper range. The next thing we'll do after that constructively is to test the upside of the 16,000 range, which is 17,600, but not immediately, just over time. That'll be the new top. We'll fail at 17,600, and then that'll let us know where the top of the range is, and we'll see how far we go down from there. All right, but let's say next week we make 1950. I'm sorry, I'm confusing down the S&P. So next week we make 1950. Sorry, I can't do math at the moment. Let's see, calculator. So 1850 times 1.1, 2035. Okay, so we're going to be looking for a range from 1850 to 2035 at the top. We're going to go 1850s. I mean, 19 is a weak bounce. 1950 is a strong bounce. We do that in 2 weeks. In the next 2 weeks after that, so next week is February, is first week of February. So towards the end of February, that should be our target, 2035. We'll probably be rejected there, drift down again into March or into the next earnings cycle. And then the earnings hopefully will be able to prove that this is an okay price and we can live around there at the higher end of the range. So that's it. Nothing exciting. That's probably going to be how the rest of the quarter goes from here. All right, and again, that's all based on that we hope that, you know, nothing goes wrong in the China or Europe or whatever. It was brief, but it's calming down again. Boy, there's a lot of indecision. So right now, look, all these hedge funds are just having meetings right now saying, what the hell should we do? How do you interpret this? What do you think of this? And everybody's putting in their 2 cents, and some people are bailing, and some people are buying, and overall we're hitting like a point of contention. But I think when everybody sleeps on it and looks at it tomorrow, they'll wake up and say, hey, you know what, that wasn't so bad, we can buy a bit more. But we'll see. All we can do now is sit there and watch and wait. So lots of fun. Any last questions, or are we good to go? Oh, nobody? Okay, guys. Well, thanks everyone for listening. That was fun and exciting, and we made $100, so $110. So I'm happy about that. It wasn't time wasted, right? You know what? Next week, maybe if we have a chance, if it's a little calmer next week, we can maybe spend some time doing the futures. Because that's something. I mean, if you guys have questions on the futures, so next week will be a good time. We can sit there and hit it early on. Hopefully, make a couple of trades and see what's good. Let me take a quick look. Just to see if there's anything I would put my money on right now. Oh, of course there's, right here. Damn it. No, you're not getting away from me. Yes! He's in. All right, now it's about 1599. That's not low enough for me to want to buy another one, but that would average me at 16. Oh, here we go. See? That's why you should always be greedy. I'm not really interested if I don't see everybody else getting away. Oh, here we go. This is getting interesting. 84. See, I don't know what anyone's saying. Obviously something bad is scaring everybody. I'll buy another one there. Oh, come on. Oh, it filled. Okay. So now I just lost my profit for the day. But now I have 2, which is what I kind of wanted. And my net is 990. So hopefully we can get back to 990 and I can sell out of one. All right, so we'll extend this a few more minutes and see what happens. But we're testing 4160 on the NASDAQ, and I'm hoping that's going to be bouncy. Okay, you got 15970. There's nothing special about that number. There's nothing special about this number. There's nothing special here. So there's nothing special about these numbers. The only good one is 4160. Hopefully it'll hold up on the NASDAQ and we get a bit of a bounce. Oh, shoot, look at that. Boy, how do you even keep track of these things? It goes so fast. So ideally, in fact, here, I'll even set the thing. So ideally, now that I have 2, if I stop one out here, I'm going to be really happy with my net entry. So I could set the stop, but I'm just kind of thinking, like, if it really pops up, I don't want to have a stop set. But I'm looking for another. I'm looking to get out and get back to one at 15,990, and that'll give me an entry below 16,000, where hopefully we get an end of the day rally. We still have an hour and a half, and hopefully we get an end of the day rally that turns us into something good. And my premise, though, see, that's the thing. I got it. What was my premise? My premise was that 4160 would hold. It did not. And do we blame Apple for this? Is it Apple's fault? Must be. Yeah, Apple took a sharp turn down. So it's Apple's fault. It's not like the whole market is falling apart. It's Apple's falling apart again. And people are selling off into the close, which is why I said today is not the day to buy. But what you want to watch for here is a nice little W forming. See this? If we start bouncing off here and make a similar upward move, at least, at least that fast up would make a nice recovery. If it's slower, that's not a good recovery. If it's faster, that's a good recovery. So that's what you want to see. Do we have an example of that? Not really in this time frame. But we are getting a nasty spike down. Look at that. Oh, man. I am not happy. So 940. Let me see where. Watching Apple here. Because Apple doesn't hold, the whole market's going down. Back to 2,000 on the TF. And that's how you can lose $500 real fast. Here we go. Okay. Whoa, look at that. That's not good. 41.40. We didn't even hold 41.50. Come on, Apple. It's all up to you. Did somebody say something? Hang on, let me check the news. Somebody had to say something. That was pretty bad. Bank of America, activist bonds, Jane Apartment, gold pops. No. Fed waves the white flag. Economic growth has slowed since Fed statement. It's taking a while longer for inflation to get back to 2%. They're closely monitoring. No, it's just more talk on the Fed, basically. It's getting a very negative spin. All right, but that holds up my original premise, so I don't mind going a little bit higher here. Let's see. I'm going to take a chance right there. Now I've got 3 at 159.69. And if I get another, now here's the thing. Once you have that number, you say I have 3 at 159.69. What if I add one here at 35? That's not going to really change that much. It's not worth adding at 35 because it's only 30 points lower. It's only going to drag those 3 down by 10 points. So adding another one here has a diminishing sort of return. And also, it's not unrealistic that we're going to get back to 69 so I can lighten up again. So I'm not anxious to add another long here. All right, I do think Apple will hold up ultimately. I do think that we're selling off for dumb reasons. If I'm going to add another one, I want to add at I want to basically add at 09. If I'm going to add another one, I want to add at 09. That would take all these down by about 20 cents. And then the average would be under 950, under 159.50. And that I would be happy with. So we're a long way from where I would want to add another call at this point now that I have 3. But again, because of the way I'm interpreting the statement versus the way other people are interpreting the statement, and I think they're wrong, I'll be happy to sleep on this if I have to. But my goal is to get back to 1 at 969 if I can. Oh, good time to talk about another concept though. There's also a thing called close enough. I have reduced my basis. So if we get a pop to 50 and 50 doesn't break, then even if I stop out there, I still overall reduce my net basis by a good amount. And so that's a success. I mean, there's no reason not to get out and take a profit on the 1/3 that I just added because that's going to give me a lower basis anyway. And that's really my whole goal in adding that was to drive my basis lower. You don't need to keep them all, and you don't need to ride them back to even. Any improvement is an improvement, and especially when things are jumping up and down like this. So meanwhile, what's oil doing? Something happened. Something bad happened at 2:30. It wasn't oil. Gold has jumped. Holy cow! Look at gold. Who do we not care about watching? All right, YG. Look at gold. At the same time, right? And let's see what the dollar did. Where are my futures? There. All right. So gold, and I'm sure silver did too. 5-minute chart. No, not like silver. Gold went flying up. Silver's up too. Copper's kind of flattish, so it's not an economic thing. If it was an economic thing, copper would be there too. This is a money thing, so how are the currencies looking? The dollar's still under 99. That's good. It's like relaxed for the dollar. Nothing exciting going on with any of these guys. Oh, the euro popped. Now, why would the euro popping make gold pop? That makes well, gold. I guess it drove down the dollar, popped gold, and then see. Here's the thing. See, the dollar fell, gold popped, but then once gold pops, it sets off technical. There are people who only play gold technically. They're not watching the dollar. They don't care about the dollar. They're just TA people. They're going to have their triggers when gold goes over 1120, let's say, and that's what happened. So gold going over 1120 triggered some buy programs that started loading up on gold here. So the dollar popping caused gold to go over 1120. That then triggered a bunch of buy programs, and they came back in. And you can see there's a pretty good buy for gold over the 1120 line. So that's what's going on there. Energy doing nothing, nothing in particular going on over here. The indexes had that tremendous drop, which was really outsized and ridiculous. So I'm happy to be long here because this is silly. And metals meets grains, currencies. Okay, so that's it. I got nothing else to say about it because there's no news that I see and nothing much going on. Whoa, look how we are. Oh, what did I say I wanted to buy more? 20-something? Damn it. 09. No, 09. Back here, in fact. Back on this line here. So if it hits this line, that's where I want to get back in. Okay, so he's kind of stabilizing here. He's stabilizing over 1,000. I still like the Russell long, but I'm already playing the Dow, so there's no reason to play the Russell too. Yes, we're not even looking at the S&P because we got Apple. Apple. And Apple's staying there, so ES. Wow, and who's up for earnings tonight? Does anyone know? Let's see. Printed that Monday, didn't I? Boy, I'd love this thing to resolve one way or the other. As long as it's sort of stuck now. Here's the earnings. Nope, that's not the earnings. Damn it. Sorry, I'm looking for the earnings calendar. There it is. Got it. Okay, who's the earnings tonight? Facebook, Qualcomm, eBay, Las Vegas Sands, PayPal, United Rentals, Texas Instruments, SanDisk, Juniper. Tomorrow morning we have Alibaba, a lot of internet tech, JetBlue, Celgene, Valero, Caterpillar. I might want to rethink those long Dows. I can't read that one. Bristol Meyer and Lilly. Holy crap. Then tomorrow after the close, Amazon, Microsoft, Visa, Amgen. Oh, wow. And then Friday morning we have nobody big. Seagate, Sony, Whirlpool. Okay, that's not bad. All right, so the biggies are tomorrow, today and tomorrow, Facebook, Qualcomm, eBay, PayPal, SanDisk, Caterpillar, JetBlue, Valero. That's all standing. So when you're thinking going long into the close, you got to really consider where the hell you're going long, right? Oh, damn it. Okay. So you have to consider what you're going long into. Thank you. All right, close enough. Oh, you bastard. Didn't fill. Come on, baby. Thank you. All right, so now, look what happened. That was a $600 reversal. So now, we're back to flat, but I've got two at 15954. I don't remember where we started. We started like well above 16, right? And now we're down 50 points for our average. So now if I get that move up into the close, and I still think we'll get the move up into the close, but I'm very worried about Caterpillar tomorrow, so I'm not going to hold this overnight. I will hold it until the close. If I get my pop on the close, great, but I'm not going to hold this overnight because Caterpillar is that much of a concern. It could really hammer the Dow and scare a lot of people. They've already warned, though. Maybe not. Maybe it won't. But there's no reason I want to take a chance when I have two contracts open. I'd rather just, if I get $100, $200 back now, I'll be happy and get out. So you always have to be aware of your environment, what's ahead of you, what's behind you, what's causing it. Otherwise, you won't have the conviction to trade. And if you don't have the conviction to trade, and you aren't trading within what you can afford to lose, like when I was down $500, I'm like, frick, 500. It's not a big deal. If 500 is a big deal to you, you shouldn't be trading like this. Future's not for you if you can't afford to lose $500 in 20 minutes. But everything right now is going the way I thought it would. We bottomed out. I took advantage of the bottom. I picked up my extra position. I have no desire right now to add more, but if we do get back to 159, I might consider it. But I don't think that's going to happen. I think more likely I'm going to get back to 1 when we're even, and then I'll see what happens into the close. And I'll feel very comfortable at that. If I make or lose $200, I don't really care. But we'll see what happens. So it's 15954 is our official break-even point where we have 2. And if I can, I want to get back to 1, and then we'll see into the close. And hopefully in the close, we'll get over 16, and that will be at least a 250-point gain. All right, but I had to go down $600 before I could get back to a point where I'll be up 250. So this was a very, very volatile play. All right, now we'll report on that next week and see how it turns out. This one's great too. 4150 is the number I wanted on the NASDAQ. We hit it while we were not paying attention. That's my long line on the NASDAQ. 1,000 is my long line on the Russell, and 1880. We didn't quite get there on the S&P. All right, here we go. 56, almost. I'm watching my P&L for the day. Doesn't matter what this says, it's wrong because my P&L for the day is going to tell me when I'm breaking even. So, given I have 2, it's really around 58 that I want to get out. Not out, I want to get back to 1 at 58. All right, here you go. I can put a sell in here. We'll see what happens. So there's my sell order. See? I clicked it. So if we get it pop to 58, then hopefully it'll fill it, and I'll be back to 1, and at 1 I could care less whether it goes up or down. At 2 I could care less also, but I mean, obviously I care a little bit. I'll be way happier. All right, anyway, all right, now we'll end it, and we'll come up next week, and we'll see how we did, okay? All right, so thanks, guys. That was good bonus time, and we can do more futures next week if you're all interested, okay? All right, have a good day, everybody.